Are you in your 30s and looking for the best investment strategies? Pause. You've come to the right place. It's never too early or too late to start planning for a secure future, and the 30s are the perfect time to lay solid financial foundations. From stocks to real estate to starting a side business, there are multiple avenues to explore. Together, we'll delve into the top 5 strategies that can help you get ahead financially. Stay tuned as we unravel the top 5 investment strategies you should consider. The first strategy to consider is investing in the stock market. Now, you might be wondering, why the stock market? Well, the stock market offers the allure of potentially high returns. Imagine purchasing a share in a company for a relatively low price, and then, as the company grows and prospers, so does the value of your share. With time, your initial investment can multiply, leading to substantial financial gains. Another significant benefit of investing in the stock market is the possibility of earning dividend income. Some companies distribute a portion of their earnings to shareholders in the form of dividends. This means that not only can you potentially profit from selling your shares at a higher price than you bought them, but you might also receive regular income simply for owning them. However, investing in the stock market isn't just about buying shares and hoping for the best. It's about making informed decisions, and that's where the importance of research comes in. Before investing in a company, it's crucial to understand its business model, financial health, and the industry it operates in. By doing your homework, you can identify promising investment opportunities and avoid potential pitfalls. Diversification is another key aspect of stock market investing. Putting all your eggs in one basket can be risky. If that company or sector takes a hit, you could lose a significant portion of your investment. Diversification, which involves spreading your investments across a variety of companies and sectors, can help mitigate this risk. So, how do you get started with investing in the stock market? It's simpler than you might think. You can start by opening a brokerage account, setting a budget for your investment, and then buying shares of a company you believe in. Remember, the stock market has risks, but with careful planning, it can be a profitable investment. Investing in the stock market isn't a guaranteed path to riches, but with patience, diligence, and a well-thought-out strategy, it can be an effective way to grow your wealth. Our second strategy revolves around real estate investment. Now, real estate might seem like a high roller game, but it's not as out of reach as you might think. You see, real estate investment isn't just for the ultra-wealthy. It's a viable and potentially lucrative strategy for anyone seeking to diversify their investment portfolio. So, what makes real estate such a compelling investment option? Well, for starters, it offers the potential for both consistent rental income and appreciation over time. Let's break that down. Rental income is pretty straightforward. You purchase a property, and then you rent it out. The rent you collect each month becomes a steady stream of income. Over time, this can add up to a significant amount, especially if you own multiple properties. Plus, the income is quite stable, as people always need a place to live. But rental income is just one side of the coin. The other is appreciation. This is the increase in the property's value over time. While real estate markets can fluctuate, the long-term trend for property values has historically been upward. That means that the property you buy today could be worth considerably more in the future. Of course, successful real estate investment isn't just about buying any property and waiting for the rent checks to roll in. It requires careful research and planning. Location, for instance, plays a crucial role. A property in a thriving neighborhood with good schools, amenities, and job opportunities will likely be more desirable, and therefore more profitable, than one in a less appealing area. Market research is also vital. Understanding the dynamics of the local real estate market can help you make informed decisions about when to buy or sell. In summary, real estate investment offers the potential for steady rental income and long-term appreciation. However, it's not a passive investment. It requires active management and a keen understanding of the real estate market to be successful. But with the right approach, real estate can provide a steady income stream and long-term financial security if managed correctly. The third strategy to consider is investing in retirement funds. Now, you might be thinking, I'm only 30. why should I be thinking about retirement? The truth is, the sooner you start, the better off you'll be in the long run. Retirement funds offer a myriad of benefits. One of the most attractive advantages is the potential for tax savings. Contributions you make to your retirement fund are typically pre-tax, meaning they lower your taxable income for the year. So, not only are you saving for your future, but you're also reducing your current tax bill. It's a win-win situation. Another great benefit of retirement funds is the possibility of employer match contributions. Many employers offer to match a certain amount of what you contribute to your retirement fund. It's essentially free money. If your employer offers this, be sure to take full advantage. It's like getting an instant return on your investment. Now, let's talk about the importance of starting early. The power of compound interest is truly magical. The earlier you start contributing to your retirement fund, the more time your money has to grow. Even small, regular contributions can add up over time. The key here is consistency. Make it a habit to contribute regularly, no matter how small the amount may seem. Let's put this into perspective with a simple example. Suppose you start contributing $100 a month to your retirement fund at the age of 30. By the time you reach 65, assuming a modest 5% annual return, your fund will have grown to over $160,000. And that's not even considering any employer match contributions or increases in your monthly contributions over time. So, in essence, retirement funds are a great way to secure your financial future. They allow you to grow your wealth over time, take advantage of tax benefits, and potentially receive additional contributions from your employer. Retirement funds not only provide financial security for your older years, but also offer significant tax advantages. It's never too early to start planning for your future. So, why not start today? The fourth strategy to consider is peer-to-peer lending. Now, you might be wondering, what on earth is that? Well, it's quite simple. Peer-to-peer lending, or P2P lending, is a method of debt financing that enables individuals to borrow and lend money without the need for a traditional financial institution as an intermediary. So, why might you want to consider P2P lending as an investment strategy? There are quite a few reasons. First off, it offers the potential for high returns. This is because you're essentially stepping into the shoes of a bank, and we all know how profitable banks can be. Furthermore, P2P lending can be a great way to diversify your investment portfolio. By spreading your investments across a range of different borrowers, you can spread your risk and potentially increase your overall return. However, as with all investment strategies, it's crucial to understand the risks involved. The primary risk is borrower default. In other words, there's a chance the person you lend to might not repay the loan. Therefore, it's essential to do your due diligence and only invest money you can afford to lose. To mitigate this risk, many P2P platforms use credit checks and other measures to assess the creditworthiness of potential borrowers. But remember, higher returns often come with higher risks. In conclusion, peer-to-peer lending can be an excellent way to earn passive income, but it's crucial to understand the risks. So, do your homework, be patient, and you could find P2P lending to be a rewarding addition to your investment strategy. Our fifth and final strategy is starting a side business. Starting a side business can be a game changer in your financial journey. It's not just about the possibility of a higher income, although that's certainly a perk. It's also about the satisfaction that comes from creating something of your own, from seeing your ideas come to life. Creating a side business can be as simple or as complex as you want it to be. You could start a blog, open an online store, or even launch a consulting service. The possibilities are endless, but the key is to find something you are passionate about. Passion is the fuel that will keep you going when things get tough. But passion alone is not enough. You also need to find a market demand. This means identifying a need or want that people have and finding a way to meet it. It's about offering a product or service that people are willing to pay for. It's important to remember that starting a side business takes time and effort. You'll need to invest not only money, but also your time and energy. But the rewards can be well worth it. A successful side business can provide you with a steady stream of income and even become your main source of income over time. And let's not forget the personal rewards. There's a deep sense of satisfaction that comes from creating something of your own, from making a difference in the world in your own small way. Starting a side business can be challenging but also very rewarding, both financially and personally. And there you have it, the top 5 investment strategies for people in their 30s. From dipping your toes in the stock market, exploring the world of real estate, setting up retirement funds, trying out peer-to-peer lending, to starting a side business, it's all about starting early and diversifying. The magic of compounding is real, and the earlier you start, the better. So, don't wait. Remember to check the description for more strategies, and remember, it's never too early or too late to start investing.